Sorry about that. I was just muted a second ago. Thank you for joining us. This is David Corwin. Thank you, like I said before, for taking some time out of your day for watching this webinar on the Brighthouse SecureAdvantage 6 product. We're going to be joined here in just a little bit by a gentleman by the name of Jared Anderson. You'll be taking it over, but we actually have some intro slides I want to get through here and to kind of give you a little bit of an idea about what IAMS is if you've not been familiar with us before. But so on the screen there, you can see in the top right our number at 800-255-5055. That is the only number that you actually need for reaching anybody here at IAMS. We feel that one number is the best way of doing that. You get a hold of a live person right away within 3 rings. That's our 3-ring guarantee. We really enjoy that, and a lot of our agents do as well. You just get a lot quicker, it's a lot more efficient way of conducting business. Next slide is talking about our new producer builders. That's a way in which we can reward you for, and these are brand new producers to IAMS. You can see the 5 different levels there: 100,000, 250, 500,000, 750, and $1 million level. That's just, you can take a look at that. There's a lot to take in there, but I have a lot of agents that have just, you know, yes. Yes, sir.
Sorry to interrupt you. I know there's nothing up on the screen except for the original.
There isn't.
This is
okay.
Jerry.
Thank you very much.
Okay. There you go.
Thank you very much. Apologize for that, everybody. Thank you, Jared. Okay, so you can see that the 5 different options there, 5 different levels. I have a lot of agents, as I said before, that have reached many of these levels and cashed out. I mean, I just look at the iPad for $100,000. I don't think there's a lot of IMOs that actually do that for you. But if you really want to take advantage of it, you know, you can use a lot of these perks for marketing pieces and things like that. That's probably the best way of using it. But we do reward you for your production, and that's a very good thing. Other IMOs don't do that. The IAMS business builders, for referring producers, there's a $50 bonus just by referring an agent to us. Another $100 if they do write a piece of business. Also, there is, you can, I always like to say, ride along with them as they do write business. You can kind of see there, we do pay a 15 basis points for life target, 20 basis points for indexed annuity. Single premium life is 0.75, and then the MIGA business, that multi-year guarantee annuity business, we do reward you for that as well for 10 basis points. That marketing reimbursement program is a great system. A lot of agents as well that do take advantage of that. It's $100 per $100,000 of annuity business, and we do have to remind you that's indexed annuity business. And of course, there's various things for single premium as well as life as well, life target. Back office support, we do it all for you. We save you time, try to make you help you work smarter, not harder. I have a lot of great things that we do here: business building, resources, case design assistance. That's what I do on a daily basis. Forms at your fingertips, we can certainly get that to you right away. Life and annuity quotes, we do that as well. That's kind of goes hand in hand with case design assistance, but we do that on a daily basis. We try to get that done within the day in which you request it. Paperless contracting, and you know, we have that insurance-based system, which is a way in which it's all done electronically, so you don't have to wait around getting contracted and take a lot of paper. We actually do all that, the paperless contracting for you. That's for Insurance Bay. And along with that, Firelight is an online submission system for your annuity business. We have a lot of agents that weren't that like to fill out a lot of paperwork, and I shouldn't say they like to do it, but they would just rather do that as opposed to using a mouse and going out there and doing a lot easier. I think that's a lot easier doing it, but we had a lot of older agents that didn't like that, but we've actually helped them to submit, and actually it's not so bad. It's actually a great system, and all the carriers that are on there, you can see on the left-hand side, Those are all the main carriers, but we do have some other carriers that are becoming soon. You can see it on the right-hand side there as well. So creative marketing solutions, we have a creative department that helps you with if you wanted to get a website. I think that's if you'd want to get one, you'd have to get a website in today's day and age. You really can't. I think that you'll be falling way behind those that actually have websites. If you meet somebody for the first time and you tell them what you do, and the next thing they do is they pull out their smartphone. If they can't find you on any sort of website, LinkedIn, whatever it is, then you'll be forgettable and you want to be memorable. And that, so you can certainly help. We can help you with that as well. So, and then the IAMS website, if you've not looked at that, there's a lot of great information on there. Just the sales resource library, I like to go on there. There's a ton of information on there if you've not been on there as well. There's not just annuity stuff. There's life insurance on there, buy-sell agreements. There's key man stuff. There's all kinds of information on there that you can look at and get some information on. You can run webs, you can run term quotes, you can run annuity illustrations on there as well. But there's all kinds of information on there that you can get your hands on. Retirement Analyzer, I don't know if you've looked at that or not. We actually have a gentleman by the name of Marcus Solar that is the expert on this particular system. It's a great way. I've checked it out many times. I've had a lot of agents work on that as well. It's just a great way to take your client's information and put it in a nice little illustration system that allows them to look at various options and ways with which they can retire or invest their retirement dollars. This is my first poll I'm going to launch here. This is IAMS Wealth Management. I don't know if we have a lot of people on the call here. If you're interested, if you're an agent that is just an insurance only agent and you wanted to maybe get a little bit more into wealth management, which we've had a lot of agents do. But certainly you can see on the screen there, increase revenue, increase client retention. I mean, everything points to doing this. There is, of course, some tests and things like that you would have to get through. But when you do get through that, it's a great way in which you can just become more marketable. And I'm going to launch this poll here, and I'm going to take a minute here. If you can go ahead and let me know if you are interested in this. I'm going to take a couple of minutes here. Or a couple of seconds rather. Thank you very much. So that's pretty much it. I'm gonna turn it over to Jared here. He's gonna talk about the SecureAdvantage product with Brighthouse Financial. We just a little bit about that. I mean, we launched this product. I shouldn't say we launched it. We got access to it back in January or so of this year, and we've seen a lot of business. Of course, COVID has affected a lot of things here, a lot of business that's been affected by COVID and all that. But just at its, we've seen. I've been in the business 23 years, working with indexed annuities for the past 15 or 16 years. We've seen a lot of business being put more towards accumulation, less than and more I should say less on the income rider situation. So this is a great product for accumulating your money. And as I said before in the title of it, which is a bit skewed there, 6.5 or 6.25% cap, no renewals. That just means that it does not renew at anything less than 6.25, and that's what Jared's going to go over here in a second. But with that, I'm going to go ahead and turn it over to Jared. And if I can do that, figure that out here just a second. You all set there, Jared?
All right. Yep. Give me just 1 second and let me know. I am set. Let me know if you can see the screen as presentable, David. And
I can see the screen.
Awesome. Well, I appreciate it. Thanks for the intro. And as David mentioned, Jared Anderson from Market Synergy Group. Just a little brief commercial on who we are. We are a product development and distribution company that established in 2014 and have done roughly $4 billion of sales in annuity over that time frame. What we want to talk about here today is our Brighthouse SecureAdvantage, as David had alluded to, but we're bigger than that. We offer more. Some of you may be familiar with our AIG product line as well. that's kind of, really something that we use to position for income and accumulation opportunities. The Brighthouse deal is something that, as David mentioned, launched earlier this year. It was actually the first couple of weeks of February that we got the product out to market. And really, it's one of a kind, a unique feature, and that's what we want to spend a little bit of time talking to you about. So the SecureAdvantage 6, as David alluded to, is new, it's unique, it's different. We come up with this concept and said to ourselves, what is it that the industry is looking for that can be a simple, safe accumulation, short-term product? And what is it that the industry likes about longer-term point-to-point crediting strategies? A couple of things that I'll list to your clients. And let me take a step back. What is it that the industry does not like about those longer-term crediting strategies? Because we knew we had an idea and a concept here. But client sees no gains in the index until the end of the crediting term, no death benefit if client dies before the end of the crediting term, no interest is credited, reducing the free withdrawal availability, no partial credit on free withdrawals, and can lose all gains at the end, no annual reset to take advantage of down market rebounds. So theoretically speaking, a longer-term crediting option will give the insurance carrier a much better option budget in order to purchase rates that are desirable to both you as the advisor and certainly the client. We knew these were objections that we were going to run across, so we come up with solutions as to how we can overcome those objections. So as mentioned, what if we could solve all of these? Client sees no gains in the index until the end of the crediting term. Actually, you have a full performance value shown on a daily basis. As of September 8th this year, when the conversion takes place, your client will have the ability to log in just like they would with any other financial institution and say, where do I currently set in my Brighthouse SecureAdvantage 6-year product? What's the current value of it? What did I start with? All of those things. No death benefit if client dies before the end of the crediting term. That daily performance value is what is paid to that client in the event that the unexpected happens and they pass away. So that being said, if you think about other FIAs in the space, oftentimes you'll have to go back to the previous contract anniversary in order to get that death benefit. This is literally changing every single day up to the minute, and that's exactly what your client would get in the event of the unexpected death. No interest credit reduces free withdrawal availability. We simplified this, and this becomes a great planning tool for you as an advisor. It's 10% of initial premium, including the first year. So if we think about that, if a client starts with $100,000 of premium in this policy, they have access to $10,000 for the next 6 years, including within a week of issue. So from a planning perspective, this is great. We know exactly what they're going to get. We know exactly when they can get it and how quickly they can get it. And first-year liquidity has become very popular in regards to one of the options this product has available. No partial credit on free withdrawals. We actually do a pro rata credit, which is extremely important as well. So the client's money isn't sitting there for 3 or 4 years earning nothing, because they will get a credit for what we refer to as time served. So pro rata credits applied. Can move gains at the end and no annual reset to take advantage after down markets. One of our crediting options, the annual sum crediting strategy, which we're going to spend a little bit of time on, has exactly that, the ability to have an annual reset. In addition to that, we have a longer-term point-to-point in the S&P and Russell 2000 that gives you the ability to do a one-time lock-in feature at any given time during the contract. We'll go through more details on that here in just a moment. So one of the things that comes up in our think tanks, if you will, in our thought process around the design of this specific product is, what is the worst part about an index annuity, quite frankly, for the advisor? And that's why we want to talk to you guys on the line here today. It's really the renewal conversation that you have to have. So we thought outside the box a little bit here and said, how can we come up with an idea, a concept, to where we can have all the benefits of an annual reset and an FIA and still give you the ability to never have to worry about having a conversation with your client about a renewal that takes place. So the problem is compounded in today's environment. Volatility increases call option prices, decreasing the FIA crediting rate. Okay, so if volatility rises in the future, an FIA will not lose money, but will lose its upside crediting power. Just giving you an example, going back to 2018 when we started the design of this specific product. If an insurance carrier had a 3% option budget, that bought them an S&P participation rate of 50%. As you all remember, there was a lot of those out there in late 2018 and even 2019. In December, that same option budget, because of volatility spiking so much, priced at a 23% S&P par rate. So if you think about what's going to happen the next year, the year after that, so on and so forth, what we wanted to design was specifically a crediting strategy that would allow the client to never have to worry about, and more specifically, you, the advisor, never have to have a conversation about renewals. Okay? So when interest rates increase, call option prices also increase. And we ask the question to ourselves, where do most experts expect interest rates to go over the next 6 to 10 years? Hopefully up. I mean, at this level that we're currently at, our expectations is that there'll be a rise. Don't know how much lower they can potentially go. Marketers and agents doing income plans, using new money issue rates with no GLWB. Those illustrations are dependent upon renewal rates being the same at issue for the life of the contract. And I'm sure all of you on the line can understand where we're going with this. Theoretically speaking, a 50% participation rate drops in over half in a 2 to 3 month time frame due to volatility in the market, and we're trying to avoid all of that. Private equity ownership of insurance companies, renewal rates are quite frankly a piggy bank for investment companies who have discretion to lower at any given time. So the biggest feature of the SecureAdvantage 6-year is that it has no renewal rates. If your contract issues today, you'll never have to have that conversation with the client as to why it would have dropped or why it would have changed or gone lower or anything along those lines. And we'll show you how we did that here in just a second. So I just want to cover a few more things, some annuity hedging basics to give you guys a better understanding as to how we came up with the solution. The longer the crediting term, the cheaper the per cost of the call option is. This is why longer crediting terms have higher caps and par rates for the exact same index. Okay. Selling the put option, which brings loss of principal to risk, the carrier receives a premium from the buyer, which can then be used to buy more call options, thus increasing caps and par rates. This is why structured variable annuities with downside buffers and floors have higher caps and par rates than a traditional FIA. Volatility control indices lower volatility by allocating to bonds, thus lowering the option cost, but also lowering equity participation, right? So recent historical bond yields have been strong since bond values go up when interest rates go down, as they have for the last 30 years. This makes the illustrations look extremely promising, but we do expect interest rates, the question we have to ask ourselves is, do we think interest rates are going to continue to keep dropping for the next 30 years? And quite frankly, I'm not sure how that's even possible. So that's where we came up with our annual sum crediting strategy to give you guys really the best of both worlds, for lack of a better term. It's a revolutionary hedging strategy feature that does long duration pricing advantages with the benefits of an annual reset. Higher credit rates from selling a 10% forward downside risk using known indices such as the S&P 500 and Russell 2000 with no volatility control. Some facts here to lay out. This design mathematically is cheaper and therefore provides more upside potential than only buying 1-year call options on the same index. It does not rely on volatility control bond allocation to produce historical performance as well. So that was a quick overview as to how we got to where we are today with the SecureAdvantage 6-year product. Okay, so now what we'll do is go into the design of it and really how to position it and where we think it makes the most sense for those individuals looking for short-term accumulation opportunities with no downside risk. Just a quick overview on Brighthouse Financial, one of the largest life insurance companies offering annuity and life products. I'll leave this screen up here. I don't need to read through all of this. One of the things that I like to focus on is in the bottom right corner. A+ rated with S&P, A3, A, obviously an extremely highly rated carrier, which in today's economic environment becomes more and more important as you're meeting with your clients. Okay? I'm going to skip through a couple of these and really get to the meat of the presentation, which is specifically the product. So when we sat down with Brighthouse to do this design, we wanted to come up with some pillars, so to speak. So why this product, what makes sense here, and what can we really focus on to really get the consumer to better understand why we designed this product the way that we did. Protection. This is an FIA, so 100% protection from downside risk. Obviously, doesn't matter what happens in the market over the next 6 years, your client can never lose money. Growth. How can we come up with an innovative strategy that gives us the ability to earn more than anything else that's out there on the marketplace today due to the fact that we have that protection of zero? And clarity. No fees associated with it. The daily difference, which gives us the ability to show those daily values, 10% free withdrawal of initial premium. Okay? So the protection pillar, we'll spend a little bit of time on this. Why is this important? Even if the index is negative for a prolonged period of time, As we all know, an FIA can never lose money, so we never put ourselves in a position where that client's going to lose money. Death benefit amount is updated daily with potential increase based on the chosen index account. Okay? Index accounts drive the potential growth with the SecureAdvantage. It's the same as any FIA. We'll talk more specifically about our annual sum strategy as well as our point-to-point on both the S&P and the Russell. The performance lock lets the client secure an index value at any given business day during the initial 6-year term. And this is only available on the point-to-point participation strategy on the S&P and Russell 2000. But think about that. At any given time over the 6 years, one of our crediting options gives you the ability to put a portion of the client's asset into the S&P 500 and, quite frankly, pick a day that they want to lock it in. If they're up 30%, 40%, 20%, whatever number makes them happy, they have the ability to lock that in, set on the sidelines the remainder of the term, and know that that's never going to change. And we think that that's a really unique feature we're providing here with the SecureAdvantage 6-year product. Clarity is pretty simple, no annual fee. There's no income rider associated with this. Quite frankly, this was part of our design. We wanted short-term products, so as the name would tell you, this is a 6-year product, giving us the ability to really focus on a short-term accumulation opportunity when interest rates are at an all-time low. So the way I look at this for you as an advisor, this gives you the ability to kind of hold on to those assets for your clients and then make a determination 6 years from now. If the client's not looking for income, we don't recommend that they go into some sort of an income rider product. We say let's set on the sidelines, accumulate that asset to a larger number over the next 6 years. Then we have the ability to reposition them into something that better fits their retirement needs. Okay? So the most important piece here that we want to talk about is the annual sum index account. Get into that here. Just an example of a couple of the different values before we do. These are some of the things that you'll see on the illustration piece. There's different values if I go back here and we focus on the bottom. Interim value, death benefit value, daily performance value, and we'll go through each one of those. The interim value is calculated daily and reflects the performance rate adjusted by the amount of time elapsed in an index term. Essentially, what this is time served. So the only time that the interim value come into play is if your client chose to surrender or when calculating RMDs, which is a great thing. So interim value is RMDs and surrender only. The death benefit, as I mentioned earlier, is the daily performance value. So at any given time, in this specific example, if your contract started at $100,000 and you're up 10%, we have $100,000. Your client unexpectedly died. That's what their beneficiaries will receive up to the day crediting, which is very unique in the FIA space. Okay, so just talking specifically about the performance block before we get into the annual sum crediting strategy, this is an example showing an up and down market, if you will, over a 4-year time frame where it appears that an increase in the market puts the client up roughly 15 or 20%. They have the ability to, at that point, lock in that value based on the performance of the participation rates that they've selected and set on the sidelines essentially the rest of the term. So obviously this is a favorable example showing them locking in at the high side, and whatever happens beyond this date doesn't matter because they're locked in that value, and we know that never change until contract anniversary when they collect their assets. All right, so now we'll get into the annual sum crediting strategy. This one is unique, it's different, it's one of a kind, it's the first in the industry, and we're extremely excited to have it through an exclusive distribution opportunity with our partners at IAMS. So the index performance is measured and stored each contract year during the initial 6-year index term and summed at the end of the term. Basically, guys and gals on the line, the easiest way for me to explain this is just like the old monthly point-to-point crediting options that we saw 10 or 12 or 15 years ago. However, this is done on an annual basis. So essentially, at the end of the 6-year term, we're going to add our positives, subtract our negatives. That's our return for any given year. And it'll show specifically on this illustration when it's coming up here in just a moment. So here's an example of the annual sum with a cap rate of 6%. Okay, so in year 1, it shows that the S&P performance is 7. We lock in at 6. 4, we lock in at 4. 13, we're capped at that 6%, as we mentioned. The following year is a down year. So this is how the annual sum works. Again, going back to the old monthly point-to-point crediting strategies that were so popular in the industry 10 or so years ago, the one thing that people didn't like about it is you could, quite frankly, lose all of your gains in the last couple of months of the crediting term, if you will. What's unique about this one, and think about the advantage that this is, there's actually a floor of 10%, and I'll show you an example on the illustration here in just a second. But if the S&P 500 is down 20, down 25, down 30%, our floor is 10%, and we can take no less than that on our annual reset option. The advantage to that is, generally speaking, historically speaking, after a double-digit down year in the S&P 500, oftentimes it's a double-digit return the following year. So we're taking advantage of that full annual reset, essentially only locking in that negative 10% and get all of the participation in whatever crediting strategy you chose for the next year. And we know that those rates can never change. So whatever it issues at today is the participation that they're going to get going forward. We have 50% participation on our highest band right now, so it's extremely good opportunity for that client to capitalize and make money in those crediting options. So here's a quick example of what an illustration would look like if you were to have David or anybody over at IAMS run it. This is utilizing the 6% annual cap. You can see 100,000 goes to a modest 123,270. Geometric average for that time frame is 3.55%. Quite frankly, that's realistic in an FIA in today's interest rate environment. Oftentimes, we get sidetracked with some of the illustration rates associated with volatility control strategies, but if we go back to 1995 when the first FIA was ever invented, the reality is these products are designed to do a couple % higher than what current interest rates are. So quite frankly, this is real, this is realistic, this is something that we think a client would be very happy with. Okay, we're going to skip through these slides and go directly to the participation. So this is the annual sum with the participation rate. This is our most popular crediting option. This is where we see the majority of the business going in. As it sets today, our current S&P participation rate on the middle band is 45%. So I want to show you a couple things specifically on this illustration. Again, this is exactly what you'd see if you call David or anyone at IAMS and they run an illustration for you. We can see in year one that the S&P 500 did 12.78%. Therefore, we're getting 575 in that specific year, okay? In year two, it did 0, so 0. Going on 13, 29, 11.39. What we love about this product and what we love specifically about this design is we know this is real, right? We know that the 45% can't ever change. This is locked in for the entire term of the contract. So again, a 4.4% rate of return is realistic. It's something that we think can actually happen, and we're extremely excited about how it positions with a specific strategy that gives you the ability to lock in those crediting rates from day one. Okay. So here's a quick snapshot of the point-to-point offering growth opportunity over a longer period of time. I would say that probably 25% of our crediting options or our allocations are going specifically to this strategy as well. If you think about it, we start at point A to point B. We have a 6-year time frame. Whatever the S&P 500 is performs out over that 6-year time frame, you get half of it. Okay, so a great story to tell your client. Over the next 6 years, we're going to dump a portion of your assets into the S&P 500 crediting option that gives you half of whatever it does. At no time can you ever take a loss, so it doesn't matter where it's at. In addition to that, we have the ability to do a one-time lock-in at whatever level you feel comfortable with. So if you feel like, for instance, 2020, an election's coming up and you're happy with the performance you've seen with this specific crediting option, let's lock it in because we don't know what will happen after the election. It's a great feature. It's pretty important, and it's something that a lot of people are really enjoying. So here's a quick example of the participation rate, currently at 40% on the S&P, but again, what an illustration would look like, roughly geometric average of 4.91%, 100,000 growing to 133,000. Okay. The last thing I want to talk to you guys about, and I know we're close on time, David, so I'll try and wrap this up, is page 17 of the illustration. Quite frankly, this is the most important piece to me. So when you do get the opportunity to call in and take a look at this specific product, I would ask that you focus specifically on this page. It shows exactly what would happen using 5 different 6-year time frames over the last 30 years in this specific crediting option and this specific design. What I like to point out is what happens after a down 23 year. Remember, we only lock in a negative 10%. Therefore, the following year, when the S&P is up 26.38%, utilizing the 45% par rate, we know that we get an 11.87% crediting option. So this page 17 is really useful. It's really helpful for the client to better understand exactly what this looks like. And at no time is there ever a year when it's negative or down. So this is a very important piece for you to pay attention to. It's something that I would recommend you go to and then have your marketer walk you through and better understanding. The last slide I have is a quick snapshot of our current rates, which can be accessed through IAMS, that can be accessed on the website, so on and so forth. And what I would wrap up with is saying that the reason we designed this product and the reason we think it fits in the marketplace today is interest rates are at an all-time low, and we have the ability to lock in a rate for our client knowing that that rate is never going to change over the 6-year time frame. And quite frankly, people's ideas, their goals, their retirement concepts change over a short period of time. This gives us the ability to put them into something that gives them a huge accumulation opportunity with no downside risk over the next 6 years. And you as the advisor can hold on to that client, gives you the ability to reposition this asset in a short period of time when hopefully interest rates rise. So please don't hesitate to call David, anybody at IAMS. I love doing one-on-one conversations with advisors to really get into the meat and potatoes of the specific product if additional questions come up. If there are any questions now, David, I'd be happy to stick around and answer them. But we're obviously extremely excited about this opportunity with an A+ rated carrier. And as David mentioned, it's really taken off. This is a unique product with a guaranteed rate that you cannot find in the FIA space for the entire 6-year term of the contract. And we're extremely excited to be partnered with IAMS to offer it through you, to you all. So if there's any questions, David, I'd be happy to get them. If not, I'm going to turn it back over to you.
Yeah, I don't see any questions at all, but we do have your names here, and I'll be giving you a call back with any questions, any additional follow-up information that I can get for you. But thank you very much for your time, Jared. Thank you for joining us, everybody. Any questions at all, feel free to give me a call back at 800-255-5055. But I will be calling you as well, just to follow up with any additional information you might have. Thanks very much. Appreciate it.